from Zoom. So I need to mute that. And okay, great. So now I've got that chat open and we are live on YouTube. I really want to thank Alan Miller, a good friend and really just, brilliant mind, and a good father and husband, for being here with us tonight to give us this talk. Alan is somebody who, not only is he a good friend and a good, advisor on all things personal to me, but he's also just a brilliant mind when it comes to entrepreneurship, business finance in general. So I'm really honored that we have him here to speak to us. And I thought that, for the entrepreneurs and the business people out there that are like me, where you feel very lost when it comes to finance, this was a great opportunity to have someone like Alan to bounce questions off of and to get some really good feedback. So I just ask if everybody, during his talk, if you could go on mute, so that we get, have the best audio, and then he's gonna present, and then have plenty of time for Q&A after. So thank you so much, Alan, and let me allow you to share your screen because you're probably trying to do that. So thanks so much, Alan. Please take it away.
Cool. Thanks so much, Todd. Thanks for the opportunity. It's nice to speak about accounting and finance to non-accountants and non-finance, or at least people who are not used to dealing with finance and accounting on a daily basis. And the reason I say this is because a lot of times people get the wrong impression about accountants and about finance, that it's sort of something scary and something intimidating, and it's something that they really don't want to be involved in. But it's a very critical process, as everyone can imagine. The primary motive for people going out into the working world, at least from my perspective, is to be able to put money in the bank account so that they can pay their credit card bills and put food on the table. It's all very nice to enjoy what you love to do, but it's also very important that you see the bank balance slowly going up over time and not the other direction. So I apologize in advance for any jargon. There are a lot of terms that I may bandy around, which are sort of terms that you're not used to, terms that I use every day, many times a day. And please note, a lot of these words may sound this way, but they are not curse words. There's a lot of words that I may use, which are you may be familiar with, you may be unfamiliar with, and I'll be more than happy to go through exactly the details, high level or in detailed, sort of about what the jargon is that I'm referring to. Todd, I don't know if you're able to make me the spotlight for you. I'm not seeing myself. There we go.
Yeah, now you are. And sorry, I have on YouTube you're pinned, and now you're pinned for everyone, hopefully.
Yeah, it's a bit unnerving for me because I'm an accountant, right? Everything is about seeing is believing. So in order for me to know for sure that I'm actually speaking to all of you, I need to see my lips moving, and I need to be able to tell that I'm being received. So if you can hear me, even if you don't understand me, but if you can hear me, just every now and again, give me a thumbs up or give me a nod. That way I know we're still in contact, and we can move ahead. Okay, let me get my presentation.
And just real quick, while Alan's bringing up his slides, I just wanted to mention too that I'm going to monitor chat. So if you guys have any questions, feel free to come off mute, ask them if they're very pointed to what he's talking about, or you can put them in chat and we'll make sure that he gets them at the end. And we'll have time for Q&A at the end as well.
Okay. How are we looking? You guys can all see the screen that shows the slides that start off small business finance? Good. Okay. Thumbs up is good because I see you're all on mute. Okay. So at the end of my name, you'll see a lot of letters. Ignore them. They're not important. They just make me feel good about the money that I had to spend on education. Essentially, CA is a chartered accountant. That was the qualification I earned in South Africa. And I say earned because, trust me, there's a lot of time and effort that goes into, you know, achieving certain professional certifications and qualifications, as those of you who have them may know. So I'm not shy when it comes to putting letters at the end of my name. Please refer to me as Alan, nothing else. No other letters are important. I did my chartered accountant degree in South Africa. I did my certified public accountant degree in the United States. And in order to propel me forward in the world of finance, after working in public accounting, I wanted to branch out into much more value-added services. And so I did an MBA, which taught me a lot about marketing and statistics and economics and a whole bunch of varied courses and entrepreneurship, very importantly, actually. And that sort of gets me to where I am today. I am the vice president of finance of a small company in Florida called MyPhoto. It's where I had the pleasure of working with Todd in the first place and meeting him. And I'm very glad to say that we have developed more than a professional relationship. We've developed a personal working relationship where I've been able to involve myself in a lot of the efforts that he's moved forward with for Poker Code, and I congratulate him for that and obviously wish him much success. I also had the privilege and honor of working with Mariella at MyPhoto. Mariella is the most talented Photoshop person I have come across, and there's been many photos that I've managed to turn into something that my mother-in-law is proud to put on her mantelpiece, thanks to Mariella. Okay, enough non-finance talk. Let's get to the nitty-gritty, and let's see how we can talk about business finance. Okay. The first thing I want to go through is the discussion today is on small business finance. So just to lay the platform, by way of introduction, what is a small business? What do we define as a small business? So obviously in different economies and different markets, the level of turnover, the amount of sales and revenue that a company is able to generate will define it as falling into a category of a small company, a small to medium company, a medium to large, a large. Obviously, you know, companies that you've heard of like Google or Coca-Cola or Tesla are not going to fall into small business. They may tell you they're involved in small business because they're involved in micro details in people's lives. But essentially, small business is defined as a company that generates, let's say, around $10 million. If you're a little bit under or you go over, even up to the point of about $30, $35 million in revenue per annum, that means each year you're generating that amount of sales from customers, whether you're selling products to customers or you're selling services to customers. And we'll go into a little bit of detail about a service entity versus a merchandising entity later on. But if you're able to generate that level of turnover, you're starting to become, let's call it a grown-up startup. You're a toddler. You're able to walk a little bit. You're certainly not able yet to run or jump, but you're starting to be a force to be reckoned with within your industry. Once you get over that threshold of 35 up to $50 million a year, now we're talking about a medium-sized entity. Now we're talking real business. We're talking about the need for a lot more complex accounting treatment and financial modeling. But for today, let's focus on small business finance. So where that really helps is your entrepreneurs, your mom and pops, your, you could think of like a doctor's practice. You could think of a lawyer's practice. You could think of a a company that's starting out in any single industry. Think of a sole provider of income who's selling goods and wares on Etsy, and they're starting to generate more and more buzz about their products, and they're marketing on Instagram, and they're getting more traction. These are small businesses that critically need appropriate financial management. So now let's talk about finance. We've defined what a small business is, but what's finance? So the first thing that probably comes to mind is money. Finance is money. And there's two really important steps that need to be thought of when talking about finance with regards to a small business. Number one is the initial gathering of finance in order to run the business. And then the secondary stage is then, okay, we've got the money, we're going to generate sales. How are we going to manage that money? How do we maximize the amount of money that comes in and minimize the amount of money that goes out? So I'm probably going to refer several times back and forth between these two steps. So step one, again, is procuring capital, bringing the money in as a starting point, as the base. And number two is now the management, the cash flow management, even on a day-to-day basis, making sure that there's enough money in the bank account to pay all the bills exactly as they become due. And this is important both for reputation, for sanity of the owners, to make sure that when they go to bed at night, that they're not lying awake thinking about, when are my customers going to pay me so that I can pay my creditors? I need to be able to get the money in from all the people I teach, all the people I serve, all the people I provide goods to, so that when I have to pay my rent, I have to pay my phone bill, I have to pay for office supplies, I have to pay for inventory, I have to pay salaries, that all those bills are taken care of. Why? Because the money is in the bank. One of the biggest pitfalls when it comes to success of startups is specifically not raising enough capital at the outset. Over 80% of startups fail, unfortunately, and almost 90% of those startups that fail because of cash flow problems. Sometimes startups fail because they just missed the boat. They were too late in bringing a certain product or service to market. Sometimes they miss the picture entirely. They're trying to sell a service or a product that nobody wants or nobody needs, or at least for the price that they're offering, no one's interested in. But a lot of times people hit the mark. They know exactly who the target audience is. They know exactly what to sell. They know exactly where to sell it, when, how much to sell it for. They just don't have enough money to support the level of operations that enable them to successfully market and sell and deliver their product or their service to their customers. This is often referred to as runway. So if you imagine an airplane needs to take off, it cannot simply just lift off the ground. We're not talking about an F-16 fighter jet here or some sort of helicopter. Most airplanes require a runway. You need to build up momentum, starting off really slowly, working really hard, spinning those engines really, really quickly, and heating up and getting really flustered and really anxious so that you can push forward and slowly but surely lift off towards success of your business. So we're going to make a distinction between profit and cash flow. Profit is very important. Sales minus expenses of the business gives you your bottom line, your profit. But that doesn't always translate into cash flows. You need to make sure that all the sales that you're able to generate, either from products that you sell or services that you offer your customers, you need to be able to guarantee that you can receive the cash from those sales as quickly and as reliably as possible. sometimes in order to widen the cone, so to speak, of customers, we're going to want to offer favorable credit terms, let's say, to customers. We may give them an opportunity to pay for the services or the products that we've provided over a long period of time. We may even give them 30 days before they start paying. This is all good and well, provided we have money in the bank in order to pay for all our expenses. And so it's very important to understand that profit is one thing, but positive cash flow is another thing entirely. And positive cash flow is critical when it comes to being able to support the efforts of the business to becoming successful. Again, step one is to make sure we have enough funding to create this runway, to give us an opportunity to actually take off and soar and become successful. And then number two is while the plane is in the air, you need to make sure you keep the wings steady. You need to make sure you maintain your speed. You need to make sure that you are making the correct and sound business decisions in order to manage your cash flow correctly. Now, I think a lot of what I've said so far is pretty much common sense. I haven't yet got to much jargon or many technical complex issues. I hope. If I have, make a note of it, type it up in the chat. We do have an opportunity towards the end of the presentation to deal with some questions and answers. Okay. Now's where it gets either really exciting, really intimidating, or really boring. Hopefully my South African accent will make it one of the former and not the latter. When we think of the owner's stake in a business, so you decide you're opening your company, you're going to provide services to customers, or you're going to open up a corner cafe and you're going to sell coffee and croissants, you need to realize that the stake that you have in the business is essentially all your assets, think cash, minus all your liabilities, think bills, and that gives you your owner's equity. If I've got $10,000 in the bank and I owe creditors $7,000, that means my stake in the business that remains is $3,000. If I were to liquidate or sell off the business today, what do I have left? I have $3,000 in that example. So that's this little red section in the middle here that you see here. If I rearrange this equation, a normal mathematical equation, if I rearrange it, instead of saying assets minus liabilities to give my owner's equity, I move the liabilities over to the other side of the equation. So sorry to bring everybody back to sort of elementary school algebra. You change the sign and your assets essentially equals to owner's equity plus liabilities. Great.
Alan, we're from the US. We don't learn that until high school.
Well, either way, there's probably even more anxiety if I bring up sort of memories of high school. I certainly have my fair share. So apologies for that. But what that does is it segues me to a really important topic. I'm going to just take a look as I'm going along. If anybody's typing any questions to me, I'm happy to try and present answers to them as soon as I come across them. So I've got my phone open, I've got the chat open, we're good to go. So feel free to interrupt me in the middle. I'm going to sort of segue into a very important topic of... I'm not sure I understand. Oh, Siri's telling me that they don't understand, so I better be a little bit more clear. The very important topic of what type of financing do you raise for the company? So, as is pretty evident, when you're starting a company, the company's going to need some money. You're going to have cash outflows that are going to need to be dealt with from the beginning. So the owners are going to want to take some of their own money, put that money into the bank account. And that's what we call owner's equity. That is what's known as capital. The other option is that instead of giving away a slice of the profit sharing pie to any other investors, one has the option of taking out a loan from a bank or any financial institution to finance the expenses. So somebody asked the question, if liabilities includes employees, to some extent, yes. We would classify employee costs as expenses. Until you've paid the expenses, it's a liability. Once you've already paid it, you no longer owe any money, and there's no more liability on your head. It's almost, if you think in your mind, if I'm able to sleep soundly at night, no liabilities. If I'm not able to sleep soundly at night, it means I need to make sure that I have the assets to deal with my liabilities. So when it comes to financing your assets, if you have to purchase inventory in order to make your sales of coffee from your corner cafe, or if you're going to be teaching and you need to provide students with certain equipment, whether it's computers, stationery, any type of snacks that you put in the kitchen, these are all these cash outflows that you need to pay for. You're either going to pay for them using owner's equity, money that you've put in the bank, or it's going to fall under a category of liabilities. You've taken a loan from the bank. The bank has no right to share in profits of the business, but you guarantee to repay a certain amount every week, month, year, whatever it is, to the bank, obviously with some factoring in of interest. That's how the bank makes their money. They're in the business of lending money. Their profit comes in by charging you interest. Your profit is going to get eaten away slightly because you needed money from the bank to pay for your expenses. You give them some interest. So hopefully that point is clear. Some of you may have heard of the concept of a double entry system. The means that anything that affects your assets also affects either your owner's equity or liabilities. So if you think of this sort of pendulum swinging, as your liabilities goes up, if your assets stay the same, your owner's equity goes down. Right? If you think of your owner's equity as the owner's residual interest in the business after all liabilities have been taken care of, if you can use your assets to pay off all your liabilities, that will determine the owner's equity in the business, your residual interest in the company. Again, I've got the chat open. I've got my phone open for those of you who have my cell phone number. Please feel free to ask any questions and I'll try and address them as we go along. That's the accounting equation. I hope it's not too daunting. When I first learned this in Accounting 101 and when I first taught this to Accounting 101 students, I had a small thromby. It's a minor heart attack. I've since recovered, but it certainly raises eyebrows for everybody who looks at it for the first time. So if there's something interesting to you or not clear or something you'd like to comment on or ask the question, please feel free to do so. Let's go back to, how do I actually go to the next slide? There we go. Let's go back to our two-step process. Remember, at the beginning, we said that finance is going to be number one, procuring or gathering in the money to start the business. And step two is the management of the cash flow of that finance. So let's talk for a second about the process of step one, which is bringing the money in the first place. There's a very scary word on this slide called a prospectus. A prospectus is not something that people come across every day. When you have large companies that want to list on a stock exchange and they prepare a prospectus, normally a several 100-page document for prospective investors to read through and analyze to determine if that investment is going to be something worthwhile. So the prospectus is essentially all about delivering a description of the business to potential investors. What are you doing? You're selling the idea of your company and marketing the flow of how your business is going to run, to explain to investors why they should give you money, even to explain to a bank why they should give you money as a loan that you're going to repay at some point in the future, again, with some sort of interest calculation. The prospectus prepared by the owners of the business is going to be very informational. There's going to be a marketing analysis to determine the target audience and how much the market might be willing to pay. There's a needs analysis to determine, are there competitors to your product or service? Is there something that is already in existence that you're going to push out, or that you're going to compete with, or you're going to disrupt? Is a very sort of hot, trendy concept. Everyone wants to disrupt these days. So is your business going to disrupt the current industry? Geographically, are you selling your wares or your services in the right place? Are you not geographically bound at all? Is your business entirely online? Can you use Zoom? Can you survive in a COVID quarantined environment? Can you not? All this information is going to go into prospectus. Nothing to do with Alan Miller. I do not deal with any of that stuff. I'm not a marketing expert. I'm not a doctor of geography. I'm not an industry analyst on commodities or IT or medicine. You need to speak to specific industry experts to get that information. But where do I come in? I come in right at the bottom. Remember, I'm the gray accountant with no personality. I help prepare the financial model, right? So that you can market and sell and present your company or the idea of your company to potential investors. And exactly as I've written on the slide there, how is the business going to make money? We're not even talking about profits here. We're talking about cash flow. How is cash going to come into the business? Where is cash going to go out of the business? What are we going to need to pay on a daily, weekly, monthly, annual basis? Where are we going to be at the end of this year? Are we going to have positive cash flow, negative cash flow? How much runway do we need? How much time until we no longer need to chunk into our initial capital outlay of the owners and we can start using our generated sales each month to fund our expenses? So as I said, I have the least glorified job in a company. You know, at a weekly meeting, I don't get to tell everybody about the exciting things that I did in the past week. You know, I tell them, yeah, I made sure I paid that bill on time. Everybody's like, good job. You know, I make sure I tell them, yeah, we maintained a positive cash balance in the account the entire month. And everybody's like, good job. So basically, why am I the least glorified employee? Because if I don't do my job, everybody's out of a job. But if I do my job, everybody gets to be a superstar. The Todds of the world get to create beautiful, mesmerizing code that create these incredible websites that can do whatever you want. You know, the customer experience can speak to how well they responded and how quickly they responded to customer queries. You know, marketing get to explain how they developed a new product and they posted it on Instagram or on Snapchat or on Tumblr or on TikTok or on this platform or Facebook or Google, SEO. There's so much other things that are so much more exciting than accounting and finance. But guess what, guys? Accounting and finance is a critical cog in the wheel. Without us gray suits, there's a lot of people who can't do their jobs. There needs to be money in the bank in order to pay the salaries for the marketing and the IT and the customer experience and production and everybody else to do their exciting tasks and get up at the weekly meeting and explain where they achieved their sort of milestones for the week. So the accountant And a VP of finance is involved with entering data, making sure that all the bills are recorded, making sure that all the income is recorded, making sure that the bank statement is reconciled at the end of each day, each week, each month, making sure that all upcoming expenses are appropriately forecast on some sort of cash flow management tool. So that step 2, which is cash flow management, can happen. All good and well. We brought in a lot of money. Investors were excited about our business. Now, slowly but surely, we are churning the wheels and ensuring that sales are taking place and we're able to pay for all the expenses to support those sales, whether it be salaries, inventory, rent, internet costs, kitchen supplies, you name it. I have the unenviable task of preparing the financial statements. The same way that at the end of the month, you want to know, where do we stand financially? How did we perform financially? And practically, bottom line, can we pay all the bills that are due? In my head, I'm translating those 3 questions are: income statement tells you, how did you perform? And I'm going to actually show you a real life example of an income statement, balance sheet, and cash flow. The income statement tells you, how did you perform as a business over the past period, whether it's the week, month, or year. The balance sheet is almost like a snapshot at the end of the period. It doesn't tell you your performance like a video, like an income statement would, but rather it's a snapshot, a photograph at the end of the period that tells you, this is where we're at. This is how much money we have in the bank. This is how much money we owe to different creditors or employees or the tax man, whoever that may be. And the cash flow statement is really a reconciliation of how the performance of the business flows into the cash position of the business, which is reflected in the balance sheet. So again, I apologize, a lot of jargon there. If there's any specific jargon that you have questions on, feel free to ask. And I'm hoping that the high level view of an income statement, balance sheet, and cash flow enables all small business owners to maximize their knowledge of where the business is financially and therefore be able to make sound business decisions. We have a comment to say that small businesses could save money through tax cuts or tax returns. That is true. Tax is a very important element of your business. And one needs to factor in both income tax and sales tax, depending on what geographical location you fall under. When it comes to tax, you need to make sure that you're consulting with an expert within the specific field. So you'll have tax experts that deal with the medical field. You'll have tax experts that deal with sort of individual niche industries, for example, gambling, service providers, warehousing, rentals, real estate. You'll need a tax expert to help you maximize the benefits available to you under the tax law. A tax expert can be an accountant, but a lot of times a tax expert is actually a lawyer. They understand the law that governs business transactions, and as a result, they can best guide you and advise you about, which are the expenses you're able to claim as a deduction, which are the sales that you're able to sort of push off as deferred revenue for tax in a future period. I am not a tax expert. That is not the field of expertise that I went into. When it comes to accountants and CPAs, you'll typically find that you have those who are involved in finance, those who are involved in accounting, those who are involved in management, and those who are involved in tax. And tax is not something that I specifically deal with. I have a sound basic knowledge of tax, but the same way that you wouldn't go sort of ask your orthopedic surgeon to look at a spot in your eye just because they're a doctor, so too you would not come ask me for any tax advice. So I'm not going to opine or give any advice regarding tax. I'm going to suggest and refer you to tax experts. And if you are having a problem with your eye, again, don't go to an orthopedic surgeon. Make sure you approach the right professional to make sure you deal with the question at hand. Okay. Let me hide this for a second. Don't be nervous. This is a very high level representation of an income statement, balance sheet, and cash flow statement. In this case, and if you'll follow with me, the cursor is going to move on the screen. I'm going to make some comments about the specific business for the given year. So year to date, we've got $20,000 worth of revenue. That is often referred to as top line. That is how much sales the business was able to generate. The cost of those sales, which are the variable costs that are directly related to those sales, were $5,000. So here I make a note, markup. In this case, you should think about, well, if it cost me $5,000, how much do I think the market can bear? How much do I think customers will buy and pay for that $5,000 worth of costs? And we've determined, right, that we can do a 400% markup on cost, right? So if you have a look, that's essentially revenue being 4 times your cost of sales. That leaves you with a gross profit, often referred to as margin, of 75% of your revenue. Great, 15,000 worth of gross profit. Other variable costs which are not directly attributable to sales, which might relate to other monthly costs in your business that are variable, that are not fixed, that are not determined by sales, but may be determined by the season of the year. You may decide that during the months of June, July, and August, kitchen supplies goes up drastically because, after all, your employees work so hard, it's only right to buy them ice creams every Friday. And so your variable costs may go up during certain times of the year and down during certain times of the year without any relevance or reference to your volume of sales. Fixed costs will typically include rent, internet, telephone, garbage removal, things like that, cleaning costs. These are fixed costs that you're going to incur every month. And so this particular business has a net profit or a bottom line of $4,500 for this year or this period. I've made a note here on the side that cost savings are available to us when analyzing variable costs and fixed costs that are not related to sales. Up here, we've dealt with our markup. Down here, we're dealing with cost savings. I'm not going to go into too much detail, as much detail on the balance sheet as I did on the income statement, but suffice it to say that this highlighted section over here of loans and investors' capital is a reference back to when I said that an owner, when starting up a business, has 2 options in terms of how they raise money to create the runway in order for them to do business. Either the owner can contribute part of his personal capital to the business bank account, or he can, show the prospectus to another investor who'll give money for a certain profit share or a certain ownership share in the business, or perhaps the owner will present the prospectus to the bank or other financial institution that they approach in order to get loans on which they're going to pay interest, but on which they don't have to give up a share of ownership rights to the business. You can see that the total of the assets equals the total of the liabilities. And you can see that even though we had a net profit of $4,500 for the year, we started the year off at 0 because the business didn't exist on day 1. But during day 1, The owner of the business was able to successfully bring in $9,500 of equity and $8,000 of loans to bring in $17,500, right? And as a result of business activities, some of the sales not being yet received, some of the expenses not yet being paid, which is reflected by accounts receivable and accounts payable, we end off the year, or we end off the given period, with $12,500 of cash in the bank. Very nice. So this gives you the whole sort of snapshot of what happened during the year. How did we bring money in? And how did we manage our cash flow to stay on top of paying bills on time, paying employees on time, making sure that the business is running? So all this falls under what we call as step 2 of cash flow management. If I could break down cash flow management into 4 core competencies, and typically this is where you'll find business owners have more knowledge than the accountants or the finance professionals, because who knows better about the trends in their industry? The person who works in that industry, who has the knowledge of that industry, or the accountant? So clearly the business owner is able to explain to the accountant or the finance professional, these are the trends of the industry. These are the current market conditions that are going to enable us to make more sales or less sales, or spend more money or spend less money, or hire more employees or cut back. And that's totally determined by very industry specific expertise. And that is why it's very important for the business owner to work hand in hand with their financial consultant, whether it be internal, whether the business has somebody who they employ, who manages the accounting function, the bookkeeping function, or whether it's an external consultant who's able to provide guidance and provide advice on how best to manage the cash flow of the business. So if I could break down again, step 2 into 4 core competencies, it would be budgeting, forecasting, gross profit percentage analysis, and cost savings. So you're all on mute. I'm not going to ask you to repeat them, but as long as you're getting from me that this is a multifaceted approach here. Budgeting is about saying, well, how much money am I going to get in? How much money is going to go out? What's going to be left? Good. Forecasting is about saying, okay, today is September 1st. We've already got our results. We've already got our QuickBooks, our NetSuite, our Sage, whatever accounting tool you're using to track income and expenses. I can tell you straight away everything that's happened from January to June. Now we look at forecasting. Based on what's happened January to June, how do we think every month for the rest of 2020 is going to pan out? In fact, how do we think the first 6 months of 2021 is going to pan out? And as an accounting or finance professional, I look to the business owner and I say, you tell me, you're the expert. Are sales going to go up? Are sales going to go down? Are we going to need to hire more IT focused staff because of the fact that we're working remotely and on Zoom and with much more data transfer? Or are we going to need to cut back on our staff because our business is very face-to-face, client focused, and that's just something we don't need in the next 6 months, in the next year? So that's forecasting. Now, again, industry-specific analysis will be able to tell me what the market can bear. So if you tell me that a company will never pay more than X hundred or X $1,000 for a given product or a given service, I don't know if that's true or not. But I'm using your industry knowledge and expertise to help develop an expectation of how do we expect to see sales trending, and how do we expect to see the costs incurred for those sales. Last but not least is cost savings. And this is this is often a very difficult area for business owners to manage, because ultimately you don't want to cut costs. You want to have the greatest snacks possible in the kitchen for all your employees to enjoy. You want to have the most comfortable standing desks and chairs, and you want to make sure that everybody's happy. You want to make sure that all needs are taken care of. But we're in the business to make profits, right? We're going out there and we're starting a business so that we can put money in the bank and pay for bills and pay our credit card bills and put food on the table, right? And that's ultimately what you're looking to do. You want to maximize the bang for all your efforts. You want to make sure that at the end of the day, week, month, year, that you have as much possible to show for all your efforts. To do that, it's important to be frugal. It's important to say, yeah, we could do with one less business retreat this year. We could do with slightly, less premium coffee in the kitchen at the office, or maybe that's, a very taboo topic. In any kitchen I've been in, I would make sure that honestly, that's the first thing that we spend as much money as possible on, because I'm a big coffee fanatic. But essentially, cost savings are about making sure that your runway can last you as long as possible, and your management of cash flow is as easy as possible. Why? Because you're being frugal and you're being cautious on your costs. So whether it be an internal or an external consultant, a successful consultant is going to be able to present useful information to help the owners of the business make sound decisions so that they can maximize their net income. Again, we're in business to make money. No one's going out there as a charity to feel, to make sure that society receives all the Apple. Imagine Apple decided that, just as sort of a nice thing to do, everyone in the world should have the latest iPhone, the latest Apple Watch, the latest MacBook Pro. That would be great, except very quickly they would run out of money and have to stop doing that. Todd made a comment to say that actual charities are in the business of charities, or are in the business of giving out charity, which is true. But if you don't have a very strong focus on a realistic amount of charity that can be given out, your charity is going to fail. Because if your money that you bring in from donors in a charity is not appropriately spent and appropriately invested and appropriately utilized, you're going to fall short of your key performance indicators, your milestones that you're trying to reach. A charity is going to want to give a certain amount of something to someone or to a group of people. And in order to do that effectively, they need to know how much that's going to cost, and therefore how much money to bring in. And if they're not able to budget accordingly for how much money is going to go out and how much money they need to pay all the people who raise the money and all the people who distribute the money, they're going to fall short on their expectations and their milestones that they're looking to reach. Lastly, and this is really where it comes to how a business owner can take a hands-on approach to managing cash flow and ensuring success of the business. Once you're running the business, the assumption is that you've raised the necessary capital. Now we're involved in the management of our cash flow, and that centers around good organization and being on top of things. Bookkeeping and record entry is all about making sure that everything that I receive in the mail is entered into my system, that I have a budget and I'm strict and I'm disciplined and I stick to my budget, so that if I'm expecting a certain level of sales to be generated in a month, if I'm below that level, I need to push harder on my marketing. I need to push harder on my salespeople. Maybe I need to reach out to my network. I need to push harder because I have this budget. And I need to make sure that when I'm looking at my actual numbers at the end of the month, that they're close to or beating my budget for sales. And exactly the opposite when it comes to cost savings. Maybe I did budget a certain amount on coffee and snacks for all the staff, but if I can be a little bit lean this month, it's going to put less pressure on the bank account, and it's going to guarantee that there's extra money in the kitty at the end of the month, end of the year, whatever it is, to really treat my employees, make them feel valued, and make sure that they're performing to the best of their ability so that the company can perform to the best of its ability. These financial statements, which form the backbone of decision making, need to be reviewed frequently. And a monthly review, in my opinion, is one of the most valuable exercises that can be done by a business owner to sort of take stock and say, hang on a second, how much did we generate in sales? How much did we say we were going to generate? For all the marketing that we spent, for all the efforts that we embarked on, did it yield the right level of sales and revenue that we expected? Or did we spend too much? Did we spend on the wrong target audience? Did we spend in the wrong place? Are we spending too much on rent? Do we really need the fancy patio overlooking the park? Or could we move our offices to the smaller office downstairs, which doesn't have beautiful views, but costs half the amount of money and enables us to spend more money on marketing, which can generate more sales? You see where I'm going with these thoughts. And so the analysis of the financial information is core to your cash flow management. I don't want to go too far over time, but I know that there's probably a lot of questions. So we're encroaching upon 7 o'clock. And for the end of the day, this is a lot of complicated stuff to think about, but hopefully eye-opening stuff for anybody who's got their own business or who's worked in a small business or who wants to open their own business. So whether it's related to jargon, whether it's related to simple concepts, whether it's related to something that I might be able to help you with, I would love for you to ask me questions. So I think Todd, as a moderator, can open up the mics. Feel free to type a question, to ask a question. I'd be happy to answer anything now. Let me know how long you'd like me to continue going on, Todd. And I'm also happy to answer any questions sort of on the confidential side, if there's something that you prefer not to ask in a public forum. I know I'm, unaccustomed as I am to speaking in public. Often when I say a sentence like that, people think I'm, a reporter for the BBC World Service. But unaccustomed as I am to public, I feel that it's so important to be able to ask a question and feel comfortable with the person answering. So if something is easier to ask by text or on a phone call with me or on a separate chat, Todd, I'm sure, can send out my details and make sure everybody has the ability to do that. But if there's anything that you'd like to ask right now, if there's anything that you'd like to type up and ask me, please make sure to speak up. I'm gonna hand it over to Todd to
Alan.
Stop sharing.
Alan, I just wanted to say that was fantastic, and I really appreciate that overview. I know that you hit on a lot of things and clarified a lot of things for me that have been really confusing just from the get-go, to in terms of starting my business. And I've struggled with a lot of those things, like the difference between an income statement and a balance sheet. And so I really appreciate the very clear explanations that you gave. And I'm sure now if anybody has any questions, I know we started a little late, so I'm okay going a couple of minutes over if there are any questions. Otherwise, I put Alan's email address in the chat. So feel free to hit him or connect to him on LinkedIn, and or connect to me through Slack. I know how to get in touch with Alan. So anybody have any questions?
Typing in my LinkedIn profile into the chat. I think that
I could beat you to it.
Okay.
There.
There we go. Okay. Yeah, feel free to reach out. Feel free to connect. If you have any questions now, it's an opportunity to get a little bit of insight into the world of finance.